Hi, welcome to today's episode of Next Normal, and I have a very special guest with Nick Bell today from Decision. And I really like the background. I like Nick as a person, but talking with somebody from a more consulting or method view, like the likes of Capgemini and Accenture and Decision, who have a global view, who think a lot about business models, who have a lot of experience and insights into developments of industries, and especially on retail and hospitality. And that's always great because there you can talk about endless things. And today we want to talk about, let's say, is the global retail model dead? And we'll dive into that in a minute. So I hand over to Nick. Very heartily welcome to the show. Happy to have you on. Please say a few words to the audience.
Thank you. Thanks a lot. My name is Nick Bell. I'm the Group CEO of Decision Inc. It's a company I've started. We operate in Africa, in South Africa, in the United Kingdom, and Australia. And as you said, we're a global services business. We help retailers and companies in FMCG and other industries really to use digital and use technology to move from the business they are today to the business they need to be in the future. And that's around creating new and exciting digital experiences, leveraging technology innovation, and helping them particularly therefore use their data to create the kind of outcomes that they need in their business in the future.
Yeah, and you mentioned the let's say three continents in a sense, but pretty much I found that focus interesting because Africa, South Africa, but Africa in total, Australia, APAC market, and in the UK, it's a very interesting triangle and something that when we talk about today, we will focus on. So the first topic, maybe when we look at a global model, something pre-COVID was, for me, an understanding. When you looked at magazines or talks, it was like, hey, I saw something great in China, like this new supermarkets by Alibaba, the Hema stores. How can we copy that? And it's so great to think about a global retail model, how global retail should be. And when we are now facing a post-COVID world, it's much more focused on a local path due to changes in regulations. But some things, when we touch there, and that would be interesting to especially look into Africa and Australia, also on infrastructure. There are vast changes on infrastructure side, how countries changed, and therefore also how the whole service model of retailers developed.
Yeah, absolutely. I think what you find is that the buying personality and the buying behaviors of countries is, and for us, is very different. When I sell into Africa or South Africa, into the UK, Australia, the buyers' value systems, even though we all may speak a common language, are often very different. And that supports that's the understanding of localization. So we could say globally it worked well in America, therefore it must work well in Africa. And when we come to the story and later about payments, as we were just discussing earlier, you've got fundamentally different payment mindsets, models, and methods in each different country. Countries value different things, brands mean different things. So the global model that we were going on, this massive globalization, which is maybe driving an average of averages model, what we liked coming out of COVID was the localization, was the ability to, the need also to bring the supply chain closer, because I think so many businesses saw major disruption. I mean, I was on one of our large listed fashion retail clients. I was once on the flight back with the MD. We'd both been in Australia together. We were coming back to South Africa. And this was really early stage. It was a Wuhan problem. It wasn't really, it's kind of coming. And I asked him, is it going to impact supply chains? And he thought maybe 5 weeks and then it should be fine, but we've got enough stock, so we'll be fine with that. And really, this was the February of last year. We were both on the flight home. And it'll be inconvenient, but we'll source, manage, manipulate, etc. And then that fundamental difference now you have, if you look at that happening, the supply chain out of China, the reliance on the Suez Canal, all of these changing routes, etc., forced us all to feel quite vulnerable. So even as we see parts in electronics, etc., like that, ports, so much stock being bottlenecked up that you kind of forced also to relook at your supply chain around localized sourcing as well, to have more from a resilience. Many supply chains were found to be quite unresilient. So there's all the drive for local versus global is also, I think, driven by the ability to source and find products that are in dumb point. There's a chocolate spread my children love. It's a German one. The name escapes me all of a sudden. But for some reason, it's off the shelves at the moment. And it can only be on the basis of global supply chains. So you've got to then look at local brands that become your step in for these kind of global products that would have been in our retail stores. So it's quite complex. It's driven a lot by supply chain. I think it's also driven by the customers. We're seeing the customers' preference. Some are feeling more locally, wanting to see more local sourcing, support more local, buy more regional, but then still wanting the kind of scale and experience that the bigger brands are able to bring to them. So it's a complex answer. And I think it's also different in different categories of retail, because in fashion, I do want global because I want the brand. In other elements that are closer to home, I may want more local because it's a different value system once again as well. So BMW in our country is now selling all the cars online and actually taken over control of the dealer selling process and pricing, because they're trying to centralize that to get efficiencies of price, etc., in the vehicle retail space, which again is very different to the way we used to operate around the local dealer and the local dealer's ability to do a deal. BMW head office is now the one that's doing the deal, not actually the local dealership. He's just a conduit to the global organization.
And I mean, we will cover that. Like I said, we'll cover a lot of those points also when we talk about payment. But I also like the part about leapfrogging, and when you said like a BMW setting a certain model. So maybe the past infrastructure was not there in that way. So it was much easier to jump into the new model. When I look at, let's say, big brands, let's take an Adidas, for example, in Germany, which was so widely distributed in the past, so many distributors or large multi-brand physical stores carrying Adidas, and then shifting to, let's say, brand-focused, only selected retailers, but trying to be very B2C oriented. And in that sense, and that's again a privilege to those big brands, once you have your supply chain all under your own brand and under your own control, you also have the touch points, and you can, yes, you will have disruptions. And during the time, I think there's nobody at the moment who doesn't have any disruptions. But if you at least have the complete view into the production and into the raw material sourcing, you're much better off than working with 2 or 3 levels in between. I just had a talk. I was in Switzerland on Monday, and I was talking to the manager of the largest multi-brand department store in Verbier, which is a skiing resort. And they were saying, hey, it's really tough as a multi-brand company having high-end clothing. Yes, now it's good because a lot of people went there for holidays, but in general it's hard because all those big brands who were relying on their distribution are now going in their own channels, and of course that gives them a lot of headaches.
So what you saw, remember, the Amazon model is that he says your market. And so what we're seeing a lot of because we do a lot with the FMCG manufacturer that's also trying to sell to customers. They're trying to look at the margin it costs to distribute the retail. So take your Adidas example, versus saying if they can, because they are also 1 mile connected from the end consumer. So the retailer dictates the terms. The retailer takes margin and defines what gets put on the shelf. And particularly as retailers have gone to these big distribution centers, it's even worse. So the manufacturer, the owner of the brand, has even less of an idea of what lands up on the shelf, what its rate of sale is.
Data. It's
100%.
data.
It's the ability of data. So they want to build the relationship. Adidas wants to control the narrative to the end consumer who wears their product. Because you've got the customer, which is the store. You may have the shopper, who in my instance may be my wife buying groceries, and you may have me being the consumer, Nick, who eats the food, as an example. So there's these different relationships, and it's the deeper, to your point on sourcing, what we're doing for some of the food manufacturers is their ability to figure out exactly what the customer's demand is in store on the day has huge repercussions to exactly what they source, buy, and make. Right now, they buy and make on 13-week rolling cycles based on assumptions of what they think will happen, not based on what actually happened last week and what do we need to therefore buy, source, etc. in order to make. Their demand plans and the leakage in the demand model is also massive. And last point was that a retailer told me this last week was the customers love to buy, the manufacturers love to buy till data to work out what their customers doing, what their products are doing, what their competitors are doing. The retailer looks at the same data to work out how much volume, how important they are to that manufacturer, so they can drive more margin. So they use the same data to negotiate a bigger discount, saying I'm 30% of your business, therefore I'm meaningful. I want another 3% on Sally's and Tally's, as an example. So it was an amazing view of how the same point of data, but each party was used so differently. So 100% data and experience. If I can control the experience of the customer and I can use data to understand what he wants more, I can have far better control of what happens in my supply chain as well.
And do you have specifically, let's take Africa, or you can also take Australia, but is there, like in this, I wouldn't yet call it post-COVID world because we're still in there, but was there in the last, let's say, year, was there something which is significantly changed there in those two markets where you can say, okay, that's exactly an example for that, how that changed, a leapfrog or something which was a change in that infrastructure or service part?
What we've seen has been exponentially larger is the brand owners of the products being far more focused on introducing new e-commerce and digital channels. Previously, they never wanted to sell to the end consumer. They never wanted to mess with the traditional supply chain route through their retail partners. They are all actively, the big guys, and we work with a lot of the big food and brand manufacturers, all are looking at routes to get to the customer. That they never did. They want to implement the similar platforms to deal with their independence, to go and support the localized provider at scale, so they can still distribute when they suit. But fundamentally, that's a major shift that's happened, I think, in that respect, is that, and all of the retailers who are trying to now become aggregators, particularly of other people's brands, also trying to drive the adoption. What we've seen, what's been really particularly relevant for me in Africa has been the food market side. So, because food traditionally, e-commerce for gadgets and for electronics and for clothes has been around, it's nothing new. But e-commerce for food and food delivery, we've seen major innovations in this market for the retailers and the brands that can enable you to order and fulfill in a very short space of time. So the one that's taken the biggest market share in South Africa is the one that at 60/60. You can order your full shopping basket of food. They leverage the kind of Uber Eats delivery model vehicles to get you food in under 60 minutes to your door, which is profoundly meaningful in this market, especially in those tougher times.
But they're like you also have in Southeast Asia. They're like those, I wouldn't say super startups, but they're like controlling the channel, because you have in China, but also Indonesia, you have a lot of those local companies who buy the Uber equivalent, who buy the grocery shopping, who buy the logistic warehouse. So they actually take all those steps and integrate them, and the payment as a part, and then build a kind of unicorn out of that, which is, I think, is also interesting, where in the past you had Uber, and then Uber pivoted to food delivery. But in the end, there you have, in those emerging markets, you have companies who actually package it all under one roof.
See, the problem that you have is that what we saw in this, I'll take the same example with these retailers, and they're all my customer, is they've been very good at working out how to get goods from a distribution center to a shop. not figuring out how to get things from a shop to a house. It's a fundamentally different delivery cycle. And the retailers that put that problem statement under their traditional logistics business have had real challenges making meaningful impacts. Yes, you can get a delivery of food next week. That's not helpful. The need is now, I need that. And what the Uber model is that its ability of that distributed distribution network, where you don't actually own everything. The retailers and the globals want to own the whole thing. And they want to own the trucks and they want to own the vehicles. And you have to, what the guys that did it well over here, they leverage being a platform, which is not retail, traditional bricks and mortar, being the platform, which is the ability to orchestrate between the delivery provider who wants to get paid, the customer who wants the product, and their stores. And what they did was what made them really good is they sourced from stores closest to you. So instead of going to a dark store model or going to this build the warehouse, they went and sourced locally. That's how they can do it. So they go and pick and pack. They had all this extra staff sitting in the store that while the store was quiet, they said, well, they can pack baskets, so they can pack bags. So the order gets sent straight to the store staff will fill it, the delivery guy fetches it and takes it away. And that was quite revolutionary to the traditional dark store e-commerce model, which is where you bring all your stock together and then distribute. It doesn't work if your problem to solve is, can I order and get the product in 60 minutes?
And it's interesting because, I mean, with Jumia, there was already a player in the market who was leapfrogging a little bit in the African market doing that, but 66 not related to that. So it's a complete new area. Yeah. And I also like your point about the logistics. I mean, I spent some time in that area, and of course doing cross-docking and thinking in pallets doesn't help you when you think in customer order sizes. Yeah, that's a very different.
You've got to think about how to move one packet or two packets or a single order. As an example, your supply chain's not geared to think like that at that speed, because the logistics was the constraint, and it was sourcing. And if you needed, the guys that did it really well were able to use what you had, which was people with vehicles. Well, that's what Uber does. People with vehicles looking for money that are mobile and agile, and then they don't want to own it, because the big giants across the world, they want to own everything. They're not good players and participators, shall I say. They're not good platform ecosystem players often. So these are the guys that do well. And the Jumia or Takealot we have in this country as well, all of them also, they've got these big distributed models as well, which is good for certain categories, but it's different for different categories. If you're in the food side, you've got a different problem statement to if you're in the electric goods side, to if you're doing clothes and fashion. And I think it's what you're getting now is the e-commerce platforms are learning how to distribute different things, how to partner. They're all frantically, another one, Walmart in Africa, which is called Massmart here, is in the process of buying one of these platform businesses now because they can't build it fast enough over here. The infrastructure they need, and they'll probably play a mighty sum of a multiple of revenue, because it's easier also than trying to go through the process of changing their logistics organization to suddenly do micro deliveries rather than these big truck cross-dock deliveries.
And maybe one on the last point on the infrastructure side, but what I found interesting looking at those models, let's say in Africa, due to the fact that you don't have the strong labor law about being independent or being an employee, and having very low rates, actually those companies are profitable in comparison to let's say the delivery companies in Europe, which have labor trouble and are highly unprofitable. Yeah.
Sure, we certainly do not have labor trouble. Let's say that. But I think your point you're saying is it's about the informal economy. What you have in Africa that is very different is the size of, I think maybe to large parts of Europe, is the size of its informal economy and the strength of it and the amount of money that exists in the informal economy. So all of the big brands, we've got another customer that's a really large liquor business, and they are desperate. They service the formal market very well. They have deliveries, they have distribution into trade. The gap is the informal market. And the players that know how to operate and exist in the informal market, that's where the real money is. Yes, it's smaller value, but its volume is enormous. And so when companies look at Southeast Asia or look at for 600 million people in Southeast Asia, 1 billion people in Africa, and a lot of big brands have tried to come to Africa and have gone away because they've failed, because they arrive with that mindset and model to come and sell a global model. Is that, fantastic example, AB InBev. In South America, they have because of the way it's regulated, they have 400,000 customers. Because every petrol station, 7-Eleven can sell beer. In the South African market, you've got to have a license to sell it. So you can't bring distribution and scale around servicing that kind of customer to a regulated market customer for selling alcohol. So that's where I say the global kind of best practice, come in and do it. You've got to understand localization. Africa, you've got to understand informal. And then to your point, we'll get to on payments, you've got to understand how that market pays. And that's learning, as I have to learn when I sell into the UK, or I sell into Australia, or up into Kenya, or through the Middle East as well. There are those nuances that you have to respect if you want to really do it properly.
Yeah, and maybe Frank, give us a quick view on comments. Do we have any comments yet which we need to answer? No comments yet. So if there are any comments from the audience, happy to write in LinkedIn or in YouTube. They should appear here with us, and we can answer them. Jumping to the payment space now, coming in, and I really liked it when you said, especially for Africa, there was a leapfrog because there was no legacy systems in place. So it was much easier to jump into digital payments, and really, in a sense, not crypto, but digital payments, which are actually all handled on your phone. So your phone is really your wallet. But not government regulated. And I think that's also a part, government regulation. You cannot copy the model of China because the Chinese payment model is a state-owned payment model, and that's a great interesting thing to look at on your opinion there.
Yeah, so I mean, South Africa is different. We've got a very sophisticated financial market. We've had it for a very long time. But in other parts of Africa where the infrastructure wasn't in place, that they didn't have the connectivity, the let's say credit cards. So we made a comment that the vast majority of Europeans are banked and are probably credit worthy and probably have a form of a credit card. Now in Africa and Southeast Asia, and I went on a VC tour of Singapore, they were looking at this in Southeast Asia, saying the problem statement is the largest part of the market that we're after is unbanked. So we don't even know who they are as a bank. That's a problem. How do you service them? How do you give them credit? How do you help them buy? And so what you had was these issues where they're solving for that problem today around, which doesn't require checkbooks of the past and credit card infrastructure and connectivity that every store must have a Visa, a machine that can swipe Visa. And also, I suppose what you see in Europe is people maybe don't want credit. They don't want to have these kind of credit complexities as well. So in many instances in markets in Africa, and an example to look up if you're interested is M-Pesa in Kenya, which is where the telcos who have the distribution and have the network have become the banks as well. And it's not, to your point, it's not crypto, so it's proper Kenyan shillings. It's a legal tender in the country. It has the government support. So it's not crypto and Bitcoin that's out on the side or anything dark money. It's legal tender. One of our clients, a big insurer, they take premiums through M-Pesa, and they've merged where the telco and the bank are one. That's the threat for banking, is the telcos can do this through, they have the distribution, you're on their device every day. They can disrupt it massively. So they've leapfrogged even the whole need for credit cards, shall I say, and the need for the machinery and the infrastructure and the network to go straight to digital wallets really quickly. And they've missed a whole era to their benefit that they didn't need to waste money on, because they're now technically more advanced in many instances because they're on digital channels first.
Yeah, and especially they don't need to cut anything out. It's a leapfrogging. So there was no legacy infrastructure like it is already here. You have your debit cards, you have your credit cards, you have everything issued by the bank. So it's much harder to enter that market. And And I think that's very, because it changes the customer journey. I mean, payment is an integral part of your customer journey. It would be great to do retail without paying, but whatever you do, the hospitality or retail, there is the payment part, and usually it's a pain in the ass because it's after you did your things, after you finished, or it's there's a queue, you have to queue, or something's not working. So it's always something which also costs money. And I think that's the point. How many levels are in between the retailer and the consumer you send the money, and how much actually ends up in the account of the retailer?
Exactly, and different countries have different models. Every bank is trying to back a fintech. That's like, there's so many. If I had $1 for every fintech that started up, I'd be a substantially wealthier man, because they're just all over the show. And it's also picking which are the ones that are noise, which are the ones that are going to be material. And also what we're seeing, and I can't talk to Europe, but it's a big deal in South Africa, is the loyalty money. The ability where brands are owning ecosystems to create that as a tender, their wallet, money in their wallet, being able to use money that you've earned over here and pay for it with these trading partners. So there's a great example, Discovery, which is in a financial services business. But they've built this kind of money model around miles. They call it Discovery Miles. But the trading over here, I buy normal retail, I get points for buying healthy food, that goes in my wallet. I get fitness points, goes in my wallet. I can use that mobile money of theirs to buy flights on British Airways, as an example, to travel anywhere in the world and convert it at a discount onto British Airways' website. So they've now also become a payment gateway trader, because they're charging British Airways on that side, they charge the retailer on that side. So that they've created their own ecosystem that I'm part of, where I will invest or use their product to earn more rewards, so I can get more free money or discounted money. But it also drives a totally different payment behavior for the retailer, because now they've got to give up margin. Discovery is saying, I can influence this customer to go to your business, and as a consequence, I want this share of margin. It creates a lot of complexity once again over there to bring that on. But they control that. They're selling the data or selling the customer, because they say, I've got Nick as a customer.
And I think that's when we talk about data, of course, payment and payment history is a large data chunk, and is a very important data chunk. And so looking at hyperscalers, probably a way for hyperscalers is looking much more into the payment space. For hyperscalers, yes, payment is integral to their customer journeys that they do. And of course, there is some margin left. The only question is, can you do it as a global model where hyperscalers want to think global? And like we discussed now, probably it doesn't work global. It's local. And the very hard example that we face with now is even putting on our kiosk systems, putting some cash machines in certain areas. So we have a certain percentage of cash terminals left in a store that you have a third of the kiosks have to take cash, which for one big hyperscaler in the quick serve restaurant area, which is just not understandable. It's a lot of costs, but it's government related that they have to do it.
Now, I think the guys that get it right, that do global and local well, are the guys that I think pay heed and spend the time, invest the time understanding local. Many of them get it wrong and don't do that. They come and apply a global template and that's where they get it wrong. If you don't understand sourcing, supply chain, the customer, what they value, you can potentially look to do global on a local. You can localize global, all right. But if you apply a single business model and assume that it's going to work in Germany or Switzerland, where you are, to what's going to work in this other market, without respecting the differences of that market, you're going to be in trouble. And you're going to waste a lot of money. And then the local guys will know that and will be able to find ways to take you out of the ecosystem. So it's possible, but it requires a very different approach to the global one business model methodology that we're going to apply universally across Europe and in markets, etc. You've seen businesses do it well, and you've seen businesses do it very badly, especially into emerging markets, which has a very different flavor. Even though, I mean, all developed markets each have a nuance, but emerging markets is a very different game, which needs to be well respected and understood. And if you do that, like I said, there's 1 billion people in the African market, of 600 million in Southeast Asia. There's a way, there's opportunity there, but you've got to work out how to work in their market.
Yeah, and I think that's a great closing comment. We already, like we said, we will have the 30 minutes over in a breeze, because it's it's like that. So 30 minutes over. There are no questions so far. If there are any questions by the audience later on, please feel free to put it in the LinkedIn comments, and Nick and I are happy to answer or to give you additional information. So thank you very much, Nick. It has been a pleasure. It's been a wonderful journey together. So have a great day. All the best, and see you soon. Yeah.
Thanks very much.
Bye.